Welcome to all the participants for the today's virtual CP meeting on early stage investing and venture capitalist prospective startup funding. We have with us CA Ashish Papadia. CA Ashish Papadia is right now he is a partner at Blum Ventures, and it's a fintech investor with a demonstrated history of working in the venture capital and private equity industry. He's a skilled financial structuring, risk management, corporate finance, portfolio management, and project finance professional. He has strong finance professionals with a SE is focused in banking, corporate finance, and securities law from the Institute of Chartered Accountants of India. He is the faculty in various platforms of ICA in this startup thing. He was earlier working in Bennett Coleman and Co Limited as a deputy general manager, chief manager, and he has been there in the Times Private Treaties. He has been there in the Standard Chartered Bank and State Bank of India. Before joining to the Blum Ventures, right now he has spent it in about 10 years in the Blum Ventures. With this, we welcome to CA Ashish B. Papadia to the today's virtual CP meeting. With this, I am handing over this session to CA Ashish Papadia to take it forward. Thank you, sir. So right now you are in mute.
Okay, can you hear me now?
Yes, sir.
Okay. Thank you, Dr. Mishra and everybody else for this opportunity. Dr. Mishra, approximately how many people on the session?
Right now, sir, more than that one is 3,000 to 4,000.
Okay, fine. So given the number, I'll just presume that people would have some background about venture capital, and the fact that people would have been in tune with the current reality that has been shaping out in the country and the overall thrust on digital investments that the country is witnessing at a broad level. So if we have people who are completely out of reality that exists today, I think it will definitely still be relevant for them to understand. I'll try and keep it, try and cover it in a fair bit of depth. But yeah, if there are fundamental questions, etc., feel free to let us know if we can do it a little better. So broadly, the idea was to spend the next couple of hours trying to share thoughts around how venture capital has been operating, how we have been seeing the current wave, and what is it that our takeaways from it, and how do we see the future shaping up, and what is it that the people who are investing and benefiting are doing right, and how can we learn from the mistakes of the past. So the idea is to make it a slightly broader session, trying to give perspectives on venture capital. And with that, let me just get specifically into a quick background and introduction so people can understand where some of these experiences and stories are coming from. So we are a 10-year-old institution, having raised 4 different funds over our lives. Aggregate capital that we have raised across our life is about $400 million, and we'll end up raising another 100 hopefully over the next 2 to 3 months. So we will be a $500 million fund house by the next end of this fiscal year. That's broadly the path that we are on track currently. So very quickly, how VCs work. The way the venture capital operates is that we will raise money and capital from third parties. Over the next few minutes, I'll try and double click on this aspect where we will go deeper into how we raise money, what are the principles on which capital is raised by venture capitalists, and what are the expectations of people who are investing money into venture capitalists. We'll spend some time around the constraints and the challenges that investors and VCs face. We will touch upon constructs around valuations, how how we look at exits, what are liquidation events, some basics around the tenets of investments or the term sheet, which is a little bit of legality of the clauses. And we'll spend a little time around the life of a typical founder, who is the one who's taking money from venture capitalists like us and most of our peers in the ecosystem. So what are the motivations and challenges that the founder faces? What are the opportunities that he comes into the business for? And what is the career and opportunity that he's chasing, and thoughts around IPO, and what does it take to be a high performance entrepreneur? And just to give a perspective on how some of these learnings have come about, over the last 10 years of Bloom that I have been here, we have three partners. Bloom was started off by Sanjay Nath and Karthik Reddy. We are three partners, myself being the third partner. I joined in 2012. And over the last 10 years, we have invested in over 100 plus digital first businesses or startups, as they are called. And about more than half of our businesses have either exited or raised significant quantums of capital post us. Three of them have actually gone on to become unicorns. What I mean by the term unicorn is businesses that have achieved a valuation of $1 billion. So in current market context, about 7,400, 7,500 crores plus enterprise value. This was a term coined a few years ago by a US research author, who basically meant to say that it is a rarity to find unicorns in the digital world. And any company which reaches a size of $1 billion of enterprise value is a business which is hard to find, and therefore is a unicorn. Dr. Mishra, my video has gone off. I hope that's fine. I can put it on, but it doesn't allow me to put it on because it is shut off centrally. No, I won't be able to do that, Hemel, because the microphone will be a challenge. So if you all are okay, I'll continue. Fine. So yeah, broadly, this is where the thought process is. We've seen 3 unicorns getting created over the last 10 years of our lives. And it takes a humongous time for these to come up. Sometimes if we are lucky, it comes up very fast. And most of the times we have to spend an inordinate time and effort to see these through. And credit to the founders finally when it eventually does happen. So this is broadly the thought process for the next 110 minutes. So let me get started into how typically a VC would operate and work. And this will be true for most other investor globally. It will be true for every investor in the country that exists. So when a VC venture capitalist starts operations, the structure is somewhat similar to what a mutual fund structure is, where you create a trust, you file the trust with the SEBI and ask for an approval. There is a fund manager. So there is one trust that gets created, which is going to aggregate capital of all the investors putting in money. And then there is an investment manager whose job is going to be to invest capital and advise the trust on the areas in which the capital that has been raised will be invested. And then there are trustees who are going to take care of the interests of all the investors who have contributed money to the trust. So the regulations that are going to be relevant are the SEBI regulations, the RBI regulations come into play, because investors would be from domestic institutions and families and HNIs, or that could be from foreign investors and families who are looking at coming and investing into an Indian fund. Most of the funds are third party. What I mean by that is a fund manager is a professional who's raising money and inviting others to participate. A few funds will be by maybe a single family or a couple of friendly families coming and setting it up together, or a corporate coming and setting aside some part of their corpus from their treasury and investing from that treasury into the fund that they are going to create and operate it from that trust. The reasons that a trust is created is mainly to make sure that there is a third party who is going to create a relationship where a manager is advising and the capital is in custody and advised by and managed by the trustees who are custodians and representatives of the investors who have put money into the trust. Can we use a company structure instead of a trust structure? Can we use an LLP instead of a trust structure? The answers to these questions is a yes. So far as we are able to see that these investors still be able.
Sir, your voice is not coming.
I'm sorry. So far as the LLP or the company or the trust is going to take an approval of SEBI before they start managing other people's money, it is perfectly fine to go ahead and create a trust structure or a company structure or an LLP structure. The terms LP and GP that you would end up seeing here are legacy terms. So the history of venture capital is that it started off about 50 years ago in the US in the late 60s and the 70s. And it was in that vintage companies like Atari, Cisco, and multiple of those chip companies were born in the US, where some rich businessmen would come together, discuss new opportunities in the future of how life is going to be, and invest into technology businesses which have a very, very low probability of success, can take a small sum of money, can kickstart an idea, and then eventually possibilities of scale. There have been multiple big businesses that have come out in that era. In that era also we saw birth of few of the large institutional investors, some of who operate in India today also, who have been investing in Indian venture capital apart from participating in US and other country venture capital ecosystems. So they use the word LP and GP, where they have a construct like a partnership. So the people who are managers of the capital and make decisions on behalf of everybody are investors. These are the people who are called GPs, by way they are general partners. And then there are LPs who are limited partners whose job is to allocate the capital and wait for the returns to come in. It's a risk product. So there could be a scenario, God forbid, where the returns may also not come in. In India, we continue to use some of those terms, and we have not customized that in the trust. We have not customized and use a different term. The ecosystem continues to use the term either as an investor or an LP. Both mean the same. Or the other term used on the other side is a VC or a GP or a fund manager. All mean the same. So when we are referring to these terms, do keep this in mind broadly. So the investors or the LPs are in India are family offices. Many of the people here on this call may be advisors to HNIs, ultra HNIs, family offices. Then there are pension funds or banks who are investors, insurance companies who could be investors. They could be corporates who could be investors. India now is also ready, where we are having fund of fund investors as well who are coming and allocating capital. These are all the Indian sources of capital. And then there have been global sources of capital as well. It's across similar categories. So even globally, you would have investors in the nature of pension funds, endowments. All of these large format colleges like Stanford, Harvard will have the endowments, and they will be investors in the tech ecosystem globally. And then there'll be sovereigns who will be investing across multiple funds globally in different countries. Many of them in the US, some of them are development financial institutions or DFIs as we call them. And there are other country sovereigns like the Middle East rulers' families. Then there are some of the other country sovereigns like Singapore government, Chinese government. All of them have sovereign wealth funds which act as investors in digital ecosystems globally. As fund managers, we would typically raise money from each of these constituencies. Sometimes we will have each of them. Sometimes we may not have most of them, but concentrate on any one or two of them. This capital is organized in AIF structure, which is an alternative investment fund structure, which is a regulation under the SEBI framework, where they have multiple kinds of AIFs. AIF meaning alternative investment funds. So there are three different kinds of AIFs. The venture capital regulations are guided by AIF category 1 or AIF category 2. In the era about 10, 12 years ago, when they came about with the AIF regulations, the thought process was more around to encourage the technology investments which are going into micro SME sectors. So a separate class was given as AIF1, where there were tax pass-through status also afforded. I'll talk about the pass-through status in the next maybe couple of minutes. And eventually the pass-through status became applicable for the AIF category 2 as well. AIF 3 is a very different category, nothing to do with venture capital. So we file to SEBI for the trust application. As GPs or fund managers, we get our license from the SEBI to operate and manage funds, collect money from various investors. And like it is the case in the public markets, where you have to file a comprehensive information memorandum giving details about the prospectus, basically, as we technically call it, giving details about the company and what is going to do, the usage of funds. Similarly, we also file a PPM with the SEBI, and that PPM is available to every investor who's going to invest in the fund, on the basis of which we get their capital. So all the terms and conditions, all the prospects and the type of opportunities that the fund will invest, how investors will get their money back, the disclosures around the risk factors, the challenges that we're likely to face are all are all documented into that private placement memorandum. There is no limit to the number of investors that we can get as a SEBI registered fund. A lot of fund managers, including us, do end up working with partners to help us raise money. The only thing that one has to bear in mind when we work with partners is that at times, because the threshold is only 1 crore rupees, SEBI allows investors, as long as the commitment to the fund is a minimum of 1 crore rupees, so far as that is permitted, anybody can become an investor in the fund. And for most funds, some it may not apply, but for most funds, the way the framework is that the money will be called upon over 2, 3, 4, 5 years. So even if you have investable surplus or a very high risk capacity, to that extent, you can invest in a fund even if you have 20, 30 lakhs of surplus per annum, and the money will be going over the next 3 to 5 years. The only care and caution that we have to exercise is that when we appoint distributor, because the thresholds are very small, it is possible that some people who we have never met or sourced will end up investing. So the promises that have been made to any investor have to be very carefully drafted into the BPM. And a situation where most of the people have been not met and only talk to the distributor should be avoidable. And there is a logical sense for this threshold to be a slightly higher number, as and when SEBI chooses to keep it that way. But for now, it is a threshold of 1 crore. Prior to May 2012, the threshold used to be 25 lakhs. And there have been several funds on the alternative side which have gone ahead and raised hundreds of crores of rupees from hundreds of investors, or hundreds of investors. with 25 lakh rupee ticket size from each of them. Not the best of fundraisers. It is a good fundraise when you have long-term investors who understand the risks, who acknowledge the fact that this is an equity capital. There are combination of institutions and retail investors who are coming and investing. That's when the ideal situation is there. But yeah, it can be HNI only situation, or it can be family offices only, fund managers. There can be variety of those. So investors basically come in and pool money into the trust, which we as in fund managers will manage. A typical way in which this will work, this will operate is for managing that fund. The fund managers will have one income and one privilege. The income will be a management fee that they will get. So they will, fund managers typically will get anywhere roundabouts of 2%. Some fund managers globally do end up charging 2.5% and even 3% per annum of fee from the investors. And then in India, the pattern is about 2%. And these fees will be charged over the life of the fund of 10 years. The fund could have extensions possible, 10 plus 2. So the fund managers, what they're meaning when they say 10 plus 1 plus 1 or 10 plus 2, is that after the 10-year fund tenure has been operated, the investors will be reached out and the fund manager wants to extend the fund subject to a 3/4 majority investor base agreeing. They can go ahead and extend the fund by maybe another 1 year or 2 years, 1 year at a time, twice, all that possible. But broadly, the funds will never exceed more than 10 to 12 years. That's the broad reality. And fund managers will have the ability to charge fees all through for that period. And on that fee, there is a GST, which is payable. So effectively what happens is, if it's a fund where they are eligible to charge 2% per annum for 5 years, and then the next 5 years only 1%. And the logic could be that you are investing money only in the first 5 years. After that, you are just managing. And you may have raised another fund. So why do you need to keep reducing this fund's corpus? So please don't charge 2% for the full 10 years. Charge only 2% for 5 years and then charge 1% for 5 years. Whatever that percentage is, it is commercially documented in the PPM. Investors are aware about the quantum that is going to be charged. On that, there is going to be a 18% GST that is liable. So effectively, assuming it's a 5-year 2%, 5-year 1%. So 5 years 2% means 10%, and 5 years 1% means another 5%. So 15% plus 18% on that will be the total outflow that will happen from the fund. On top of it, there will be other operating expenses of the fund itself, which is the accounting fees, the audit fees, the trustee fees, all of that, which will be debited. All in all, a fund will suffer a leakage of roughly between 15 to 25% of the total corpus. So the investable corpus will only be 75 to 85% depending on how the fund has been structured. Some very efficient funds where we have run our fund vehicles for only 5 years, the leakages have been as low as 10%. And then there have been 10-year vehicles also that we have raised where leakages are as high as 20%. In the market, we have seen 15-25 as a common range that includes every possible outflow, and the residual becomes an investable corpus. So what I have put on that deck, this is an investable corpus, and this is approximately 80% of the funds that have been raised from the investors, and the leakages, which is fees, operating expenses, taxes, all put together end up being approximately 20%. So that's broadly the way the investable capital is arrived at. And now this investable capital will be the one that will be invested in multiple opportunities over the next few years. So typically a fund manager will have anywhere between 3, 4 or 5 years of an investment period over which they will invest the money, and thereafter there will be the harvest period. And after the 7-8 years are over, monies will start coming back as these portfolio companies that the fund has invested will start exiting. The modes of exit, I'll talk about it a little more in greater detail over the next hour or so, but the mode of exit are clearly M&As and secondary sales. Secondary sales, what I mean is when some other larger investor comes and buys the smaller investors out. And now, over the last 12 months or so, IPO has become a fairly attractive opportunity for digital companies to give exit to their investors also. And once that money comes back, that money will flow to the unit holders of the fund in the ratio of their unit holding. So there, the fund managers normally will keep 20% of those units for themselves. And the reason they keep those 20% for themselves is like a typical startup founder who will incorporate the company and keep 100% equity for themselves. If there's a three-member startup company, or in the 30 years ago, somebody would have formed a private limited company and grown. When the promoters would have created the company, they would have held all the stock to themselves. They would have invested 1 lakh or 10 lakhs for holding 100%. And when they get other investors inside, is when they will give them a stake, they dilute. But when new investors come in, they come in at premium. So instead of somebody giving 100 crores, they might hold only 25% stake, and the promoters hold 75. In the IPO, they may give away another 25% stake, so they will come down to 49 or 50. Similarly, in a fund, it's a very common practice that 20% of those units are by default subscribed to by the fund manager. For that, they may not put 20% of the capital, they may put maybe 1% of the capital or 2%, like how a promoter will put only 1 lakh or 10 lakhs or 1 crore as the initial capital. And this is basically, the logic is that as fund will grow up, as the fund will scale, investors will get their multiple, but the fund managers also should have an incentive to outperform. By giving them just a fixed 2%, about 50 to 80% of that 2% is just cost. Hardly there's a scenario where that there'll be a surplus unless somebody is running very big funds. So typically India, the scenario is still fresh. The ecosystem is less than 20 years old, and fund managers typically don't have very large size funds. So in a scenario like that, when the fund size is less than 1,000 crores, approximately 50 to possibly 80% of that corpus goes away towards expenses. Expenses are fund management, teams expense, traveling, setup costs, legal fees, etc. All of it bundled together is what will count as an expense, which the fund manager has to incur from that 2%. So if the fund is very large, yeah, there have been clamors in the US markets, in European markets, where people run 10,000 crore funds, 20,000 crore funds, 50,000 crore funds, and they still charge 2% fee. What that means is that every year there is roughly a leakage of almost 1,000 crores plus. And these are massive expenses that are let go. And there is a clamor in the US for families and all that to go directly invest. In India, it's a nascent ecosystem. It is still a right assumption to make that it's best to have some relationship. Like we say that direct investing should be done when you understand, when you know in the public markets at which company will do well, you spend time doing research, one does fundamental analysis, sometimes even technical analysis. Otherwise, it's safe to do a mutual fund. Similarly, if a individual has a track record, understands early stage investing, understands how to evaluate a paper plan or a promoter, and invest meaningful check sizes. In a listed market, one can invest even tiny 0.5% of their wealth, which could be 1 lakh or which could be 1 crore or 10 crores. And in the ecosystem in digital first businesses, 1 to 5, 10 lakhs will not give anything. And the deal flow may be adverse selection, because the best of the founders who are raising money will want to go to an investor of high repute to take money from. And then if they don't get it, is when they go to a family office. So this is briefly the overall scheme of things, from how a fund is structured, the legalities around it, what are the jargons that gets used in the industry, what are the leakages, outflows, incentives for various parties involved. Typically, I think over the last 20 odd minutes, I have managed to cover the incentives economics on how investors operate. Now let me come to the next step, which is having raised a fund. Let's say somebody raises a 100 crore fund. That is exactly how our first fund back in 2011 was. It was a 100 crore fund where we went ahead and pitched to over 500 plus individuals and families to give us money. And about out of those 500 to 600 people who we pitched, 50 were kind enough to take a leap of faith and say that, yes, I think these guys are serious or sincere. Let us give them a crore and see what happens. And they made a leap of faith and took a call for a 10-year relationship. So once that job is done, is when you have done the fundraise. So we are GPs here or fund managers, where you would go out and raise money from some of these families, etc. In this, we were lucky. Towards the end, the government had declared a fund of fund program, and we raised about 20% of the corpus from the government. So government was also partaking in our success and growth, and it was an important milestone for us. And finally, once the fundraise is done, maybe you want to raise 100 crores and you have raised only 20 crores, we can do a first close where we basically collect the 20 crores, and we will not collect the full 20 crores at one shot. This 20 crores will come as in installments. So typically these installments could be 10, 20, 30% at one time. And in private equity funds, these could come in on a deal by deal basis, because private equity funds typically don't do investments more than 6 to 10 or maybe 15 investments in a fund life. So they can afford to call on a deal by deal basis. As startup investors, we'll typically take money in chunks where we take 15 or 20 or 25% at one shot. So broadly, this is how the journey will start. The post that sourcing of 20 crores, now we are, instead of doing one thing, we are doing two things. One, we are spending time and raising the balance 80 crores. Remember, we have raised only 20 so far. We are still looking at raising another 80. So we are still looking at sourcing another 80 crores and meeting people. On the other hand, we start sourcing opportunities to invest so that we can figure out who's doing what and then make calls for identifying companies that we are going to start investing into. Once we discover interesting opportunities, it's when we move to the next stage. But here, let me spend a few minutes on trying to share thoughts on how do we make decisions on sourcing also. Decisions are not to be made only at the time of investing. Decisions are to be made at the time of sourcing as well. To give you a few examples of these questions that we ask ourselves at the time of sourcing these opportunities. One, are we going to be sector agnostic? Yes, we are tech investors, but so what? Within tech, are you going to do everything that is going to have some or the other tech connect? So you will do e-commerce, you will do cab aggregators, you will do bus aggregators, or you will do only deep tech stuff, which is high quality opportunities where there is innovation. There will be interesting opportunities of high quality and caliber on both B2B side, which is the innovations and product-based companies, or there could be innovations on the consumption side as well. So a fund manager has to make a call on what verticals they will invest in. Some fund managers say we are going to be only focused on innovation. Some say we are only going to be focused on consumption. Some say within the innovation or consumption, doesn't matter. We will be focused on anything which is fintech or anything which is edtech or anything which is agri or likewise. So there are specialized, verticalized fund managers who do either enterprise businesses or consumer businesses, or there are very, very specialized businesses which do agri, fintech, edutech, health tech, etc. So within these, and when they say they will do agri of enterprise nature as well as they will do investments on the consumption side. So broadly, this is where the decision has to be made, because if that decision is not taken, one does end up spending an inordinate amount of time looking at opportunities, and many of these opportunities may not possibly be very, very relevant for the fund manager to invest into, and that ends up becoming a little bit of a suboptimal usage of time. So it is important, critical to identify the strengths, And here, the sourcing should be done in a manner which will make sure that the fund manager is playing to its core strengths and where they can attract the best possible pipeline. And if you're not attracting the best possible opportunities and founders to come and work with you, the task becomes doubly or triply complicated. Because in order for us to make money as a fund, it is fundamentally important that when we win, as in when we've discovered on the right opportunity, there has to become a mega hit. I'll come to the power law in the next maybe 15, 20 minutes or half an hour. And there'll be very significant loss ratios. In spite of trying to choose the best of founders, trying to have best of procedures for investing, between 30 to 60% of the investments will go for a loss. So what I'm trying to say is that in a 100 crore fund, very simplistically put, 50%, just as a number, could potentially be zero. It is only the remaining 50% which is going to make money. And investors typically expect a significant return of 20-30%, and it means you need to deliver a 5x. That's what we are working towards. And 5x on 100 crores means 500 crores. But that has to come only on 50 crores because the rest of the 50 is write-off. And within that 50 also 20%, let's not forget, is a leakage on account of fees, like I told you earlier. So effectively, it is 40 crore that has to make 500 crores. If the fund target is 5x, the winners of the fund which do well have to actually deliver an average of 12x. And within that also, there are all kinds of winners. Some of them generate only 2x or a 4x. So the big winner, every fund has to have at least 1, 2 or 3 big winners which generate 15, 20x of what the original investment was. And when we fail to do that is when the returns of the fund suffer. So that's where all of those decisions have to be made at the sourcing stage. That will determine what is the quantum that we are going to invest in, what is the stage at which we are going to come in, what is the stake percentage that we are going to hold in the company at our entry. So the 100 crore fund that back then, we basically made a call that we will invest in about 50 startups, each of them taking about a crore from us and then reserving money for more investment after they have started to become successful. And maybe we'll take stake of about 5 to 12%, average of let's say 10%. So all of these decisions have to be taken initially with some kind of assumption and some experience, and make sure that the best of the founders are going to come and work with you. That happens when you're going to do much more than investing. I'll again come to that in the next half an hour. So once that decision has been made, where we have gone ahead and discussed what is it that we are going to source and what are the things that we're going to look forward to, it is post that we will start excuse me, it's post that we are going to start investing. And this investment will include going ahead and understanding the business that the founders have gotten into, try and figure out what their track record is. We'll have all types of founders in our fund 1, and of course now we're in our fund 4, and we have seen 200 plus founders, 250 in action. There have been founders who have been in their teenagers when we have first met them, and then there have been founders who have been in their 40s, which we have invested in. And I am not exaggerating. We have once in a while, rarity, but once in a while, the nation of entrepreneurs that India is, we have seen entrepreneurs in the age of 17, 18 as well, but that's a rarity. And then there have been entrepreneurs who reach out to us in the age of 50 and 62. So broadly, it is a diverse group, but the best time or the best age cohort that we end up investing in is in that rough range of about 25 to 35. And the logic and rationale for that, I'll come to it. And when I say what the criteria we allocate. So we do diligence, we look at various structures, what do we want, what are the terms and all that, and finally we make investment. So that's the stage 3 in our lives. And here we are doing 3 things together. We're still raising the remaining 80 crores. We might get some on the way. We're looking at sourcing, and we are looking at starting to invest. And then we have to add one more thing post investment, which is working with the portfolio. So the job of the investor ideally should not end at just cutting the check. If you are an angel investor, you can go ahead and make the investment and just let it be. If there is an additional investor of an institutional nature on the cap table, and but as an institutional investor, we will work closely with these companies on various support that they will need, other than sitting in their place and doing their jobs. So they might need amplification on what their business is, so we help them market. There are support that they will need where they'll say, please connect us to the first 20 clients. So we'll open up our Rolodexes and connect them to various people in our network and help them meet across various set of people who will then come and become possibly their first set of clients and work closely with them. So broadly, there will be variety of support functions that will go about for the founders that they will receive from the investors. Best of the investors will definitely be trying to do many more things, but an average investor will still find ways and means to do at least one or two things to support the portfolio and add value to the investment. We have seen angel investors also, founders also being very picky on who they want to work with. They want to work with people who are going to give them high quality advice. They want to work with people who are trying to work with when they can get something more than the capital. And that is what helps the startup to take this to the next level. So broadly, the thought process and the vision is to be not only invest money, but even support the company. And then hopefully ideas to make money as well. So this is broadly the job, and this will only be made. What I'm referring to is exits, M&As, IPOs, all of which takes anywhere between 5, 6, 7, 8 years. In our fund one, it took us roughly the 4th year or the 5th year to get to our 4th year, to get to our first exit. And before that, we had a very tiny M&A, but a meaningful exit happened the 4th to the 5th year. And the bulk of them happened only about a year ago. So it takes inordinate time and patience and effort to get to high quality outcomes. And only investors who have a lot of capital should be looking to invest. These are just information slides. I don't want to really spend a lot of time into it. But yeah, examples of venture capital globally where they will teach us that, okay, there was whale industry, the shipping industry. In some sense, British East India Company was also an expedition or a venture investment by the Queen to figure out newer territories, and that's how they came to different countries and had colonies and all that. So, but we as a country, we are as a culture also had a lot of examples of venture capital where our Raja Maharajas in the olden days were incubating or helping incubate projects and infrastructure and all that, where they will appoint businessmen to work with, and they will take the risk or they will share the risk. So there has been a fair bit of examples in our country, but yeah, the modern venture capital, the way we invest today, the way we structure things today, is largely originated from the US as a construct, and that's what we have historically been following. The big countries that have a large ecosystem around venture is US, India, China, Israel, some parts of Europe, more particularly UK, etc. A little bit in countries like Singapore and Australia. There has been a fair bit of venture capital now coming into our neighborhood as well, Pakistan, China, Bangladesh. There is an interesting bunch of companies coming and opportunities coming there as well. So today, when you look at the American indices and the top global companies, every single of the top 5 companies, and I dare say maybe 8 out of the top 10 or 7 of the top 10 are venture funded businesses. And they came about in the last 20, 30 years, and now today become market leaders. And this is broadly the trend that we see will continue to operate, where the disruption will happen. A small number of companies becoming mega big. For every one Facebook, there would be 10 other companies which we would not even ever hear of, even if we go to scrape the surface. We will hear of maybe, in addition to the 10, maybe we'll hear of maybe 3 or 4 if we try and dig really deep. But it's only one out of those 15, 20, 30 companies that become so mega big that we are seeing these outcomes being discussed, deliberated on. It is a mega large category in the Western markets, in the US, in China. India, it is relatively new, but yeah, over the last 12 months, just as a heuristic, we have had inflows to the extent of almost $50 billion. So roughly, that is a massive number that is coming in. Every billion is roughly about 7,500 crores. So we're talking about 3-4 lakh crores that has been coming in as a venture allocation. A large chunk of it, when you look at, comes into mega large opportunities, but $1 billion coming into tiny opportunities also means that 1,000 investments have happened of $1 million each. So that's the power of capital, and that's the disruption path that we have taken as a country. Having said that, it's the riskiest asset class. So people on this group listening, if you are spending time and bandwidth advising your clients, this hands down is the riskiest asset class of investment, and therefore you expect that there will be the maximum possible returns that investors expect. In the Indian markets, typically we do see that G6, etc., will command maybe 6, 7, 8% return. We'll have debt funds, etc., which are a little higher, equity funds at 10, 12, stock markets at 12, 13, 14. This year has an exception on the stock markets. Let's wait for the next few weeks. Hopefully it sustains. But broadly, it has been an exceptional run. So that's why you see a mega return performance. But otherwise, it is going to be in the range of about 12, 13, 14% and not higher. But when it comes to private fund investments, the expectation suddenly goes into the 20 territory. And now that we're discussing the expectations and the return profiles of investors, let us spend some time on what are we talking about. So when we say that you're looking at investments funds that should deliver about 20%, if it's a 10-year fund that has been set up and which is looking at delivering a 20% return, it has to collect money over 4 tranches or 5 tranches, and then finally it has to deliver a 4 to 5 times multiple. So like I said earlier, typically when it's only mapped to successful companies doing well, it's actually a 10, 12, 15x. And within that also, like I was telling earlier, about 10 to 20% of the units are founder share class or the investor share class. So their investors will hold that. So in order for founders or GPs to deliver to the investors a 5x fund, they have to first deliver a 6x, because 20% of that will go to the investor, the GP, the fund manager, and the 80% will go to the investors. So whatever you promise to the investor has to be grossed up, and accordingly it has to be a massive outcome. And that's where the challenges come, and that's where you see very few funds also succeed. Typically, a top quartile fund which delivers very well will have at least one company in their portfolio which delivers a significantly big outcome as a function of the fund size. And aggregate basis, the top 6% to 8% of the fund investments in number will produce about 60 to 80% of the returns. This will be true in value, actually, where we are basically saying that if a fund is about $100 million or 100 crores, the same example, and is invested in 40 companies, the top 6 to 8% are going to deliver the chunk of the investments that are going to matter to the investor. So broadly, this is where the power law comes up, where 6% will deliver 60% plus, and significant number will not end up delivering anything. So that's broadly the power law that is referred to on the slide. We've gone through this, most of it. I'll just quickly spend half a minute and breeze through in case there is anything that I have not covered. On the taxation front, typically a pass-through status is what I had not discussed earlier. So what a pass-through status means is that in a fund setup, whatever capital is being invested by you or your clients who have come into the fund will be taxed at the fund level if it is a Cat 3 AIF. If it's a Cat 1 or Cat 2, suppose you invested 1 crore, your gains and losses will be evaluated on a company by company that we have invested. So as a fund of 100 crores, we invested in 40 companies. Each company was 2.5 crores, let's say. Now 2.5 crore, the first company got exited and we made 5 crores. So the cost of investment of all the investors will be 2.5 crores combined. You will divide by the percentage that you have invested. So let's say you contributed 5 crores out of the 100 crores. So you're 5% of the fund. 2.5 crore will be 5% divided by 5%. So you will end up with 12.5 lakhs. That's your investment. It's a cost of investment, and it has doubled to 25 lakhs. So the investor in their books will have to pay long-term capital gains of 12.5 on 12.5 lakhs. When we return the 25 lakhs, we as fund manager will deduct TDS at 10%, and whatever is the remaining you will pay as a long-term capital gains or short-term as the case may be on the tenure on which we have invested and held as a fund. So there's a pass-through. It assumes that investors have directly invested for taxation purposes, and there are separate procedures that some of you possibly may be aware of. These are Form 64, BCD, etc., which are available, which we file so that the credit is available and there's a tracing and track record available for CAs and auditors and tax advisors to file their returns of income. So broadly, that is the only part on this slide that is not covered. Now, we're just getting into the second part of the presentation, which is about the early stage strategy. This is just a lighter moment as to what happens before the startup. And there is a euphoria and enthusiasm when we invest. Every time we go into the company, we try and convince ourselves that this is going to be a mega large outcome that we are investing into. And it does reach a point where after a few quarters or maybe a couple of years, reality starts sinking in, and we'll start struggling, we'll start gasping for breath. Finally, after maybe a year or two, things might start working, and we'll discover a good product. Investors are accepting the product and coming in bigger money at a growth level. And then finally, we end up delivering a mega scale. So broadly, this is where we have a typical evolution of a startup journey. And most startups will go through their ups and downs. There are a few lucky ones which end up going only up and up and up. They never look back. And we have seen that in a few cases. And broadly, in terms of the history, if one in every maybe 100 will become a mega large unicorn, as I was referring to earlier. And maybe 10 in every 100 will become mid-size outcomes. Another 20 will be small outcomes, and the rest of the 60 may be complete write-downs. So broadly, that's the evolution curve and a typical journey that happens. We'll spend a little more time on the product market fit. We'll just take maybe 30 seconds of a pause for people to reflect on, and then I'll just get the second section. Okay, so let me now get into the second section, which is all about the product market fit. So Before we begin our journey, everything is like at a very early stage. And we are typically coming in at a point where either it is a pre-product business, pre-revenue business, or maybe an early revenue business. What I mean by a pre-product business is that we are coming in when there's not much that is there. We are trying to evaluate what is likely to work, what is not likely to work. We are also trying to figure out how big some of these markets are going to be there. And we are taking a fundamental call on the caliber of the founder who is going to do that with his track record, trying to do heavy referencing, trying to build our thesis. And broadly, over a period of time, it gets to a point where we will end up screening maybe a few tens of founders and then end up making one investment. On the criteria that we will typically look at, there are three big criteria that we will try and evaluate from. We will try and figure out, one, how strong is the founder? All the money that is going in is basically only into the founder who we are investing in. And second criteria is the market sizing, how big the market is. During our first fund, we did make a few investments, which in hindsight, we do feel that they were avoidable. We were learning, we were first time investors back then. And we felt that we will, to the extent we're identifying great founders and good teams, giving them money, deserving to give them money if they do well, I think it'll do well. And you suddenly realize the fact that, yes, they have delivered well, the product is ready, but whether the product is a market fit is not what you know. So you gave them 50 lakhs, you gave them a crore, and now they come back to you and they've developed a great product. You feel that now I can transact. It is a good commerce platform, but you don't have any transactions. You take it to the investors for giving in more money, and the investors look at it and say, I think this is a good idea. We are working on the thesis. We're trying to figure out whether it's a worthy proposition or not. So please come back to us when you have maybe 2 paying customers. If you're selling to enterprises, if you're trying to sell to the Mahindras and the Reliance and the Tatas and the Birlas, please go and sell to 2 such large corporates. And once you have sold to them, and they start paying you a fee of maybe 2 crores, 3 crores per annum is when we will come in and invest in you. It is not easy to work with an Indian corporate and get fees out of them or money out of them. So a lot of companies do say that, okay, US is a slightly more aggressive market. There, the enterprises are more supportive. Let's go and make investments there. This was a scenario 5 years ago or 7 years ago. Things have changed over the last few years, but it is still work in progress at best, is what I can tell you. We still have a massive risk averseness with our corporates. The larger corporates like Reliances and Tatas are showing the way, where they are spending money on the digital ecosystem. They're investing, they're adopting new technology. They have a tech team which is building products and all that. But there is a fair bit of catching up to do for the other corporates, as you may have already seen in many of your clients. When we meet with some of these gatherings, which are study groups or other events, not necessarily by the institute, in our own networks, people do go about and trying to figure out, okay, some surprising trends where people have invested in the fund just so that we can learn from the trends and adopt technology in our setup, or look at interesting patterns and make ourselves future proof. So there are different reasons why people make investments and look at allocating capital into funds, etc. So coming back to what we look at, like I said, the founder is the most important criteria. 60%, 70% of our decision depends on that. And equally critical is the market size. I admitted candidly that we have had our share of mistakes. Thankfully, the fund is doing well in spite of those mistakes. We've learned it the hard way, but we have good performance, so not a major complaint. But when you invest in a small market opportunity where the business can't really scale, it ends up becoming a suboptimal outcome for us. And that's where we do get a little constrained, and the returns may end up suffering as a fund. So having a very large market opportunity is something which is important for us to evaluate. Uh, and that's where, when we look at the options and opportunities, we end up taking very few bets. Initially, we played a lot more companies and realized the fact that we have gone fairly wide. And over a period of time, as we have raised larger rounds of capital, we have also come to investing much lower. So in Fund 1, we typically did 100 crores across 50, 60 companies, a little more. In the latest fund, which is a $100 million fund that we've already deployed, it's 100 millions or 750 crores. And the number of companies are going to be less than 30. So 7x the fund size and 1/3 less, or maybe 40% of the number of investments. The per company capital is much higher. And the reason is that you need a little more money, not just 50, 60 lakhs or a crore to start up. A good founder will not want to start with a small amount. He says, I know things. I am not a 22-year-old who is first out of the college, just maybe 1 or 2 years of experience, or I'm not 28 with 5 years. I'm 35. I sold off my last startup and now I'm coming again. I want more money. I know what to do. I have covered the 0 to 4 or 0 to 5 journey. The next startup is going to not make mistakes that I made with my first startup. So then you can't start with 1, 2 crores and say, give me 10, 20%. I'll cover the valuation in the next 20 minutes or so when I come to that. So achieving the product market fit is all about a product which is going to be a very limited functionality product, where you launch it with a limited set of customers and test it out and see how the response is. It's a no frills product, I would say. And you now try and establish behavior, learn from the trends, and figure out what works, what does not, iterate the product, work with your engineering team to develop more things, and eventually go and raise more money. So the ecosystem, the way it shapes up, is where investors like us come in very early. This is seed investments and pre-series A investments. And there are early investors who come in a little later than us, but they're still early. This is called Series A. And the reason these are called seed round, Series A round, B round is, again, we have just stuck to terms that are used in the Silicon Valley in the US. We have not complicated that too much. There, they would typically call them as a preference share Series A. We're just calling it the same way. And there will be different terms used by different people. And broadly, we do see that there is a trend and tendency to have interesting nomenclature. Sometimes you use seed plus pre-series A. It's all doesn't mean too much. But from a stage perspective, it means a lot. When somebody says, I'm at a pre-series A, it means that you have a product ready. You possibly have little revenues, or maybe you are just starting to build out your revenue. Series A means that initial set of revenue is there, and now you're trying to get to a product, your early product market fit, and now you want to get to a proper product market fit. There is a little bit of fungibility even in stages, where seed pre-A might mean the same, a little different here and there. But DCD is all about mid-stage. DE and all is about late stage and growth. So B onwards is where growth stage starts, where the company is actually getting money only for expansion purposes. They will still use the money to create better technology, more sophistication, and build a moat for themselves. But that capital is largely to make sure that they are able to continue heft scaling and build a moat around themselves. The mortality bit we have covered. I've conservatively put a 30-40% death ratio, but we have seen that it can be higher. And in spite of the fact that the death ratio is sometimes higher, would be 50% plus, we do see that returns of 25% are achievable. Because remember, as I said, when businesses do well, they have to do exceedingly well. So in our business, investors will be having the mindset to forgive us for the loss ratios. Nobody will creep about the fact that you lost 5, 6 out of every 10 investments that you lost. But the fact that you picked big and you were able to make a big outcome is what people evaluate and judge us on. And in there are interesting scenarios and stages where after investments, we do end up having to invest again in the company. As a cadence, most investors may choose not to invest again after they have once invested, unless it has gotten validation from an external source. However, few investors like us, we believe in conviction. So if we have seen that a business is doing well, we don't want to go and make sure that there is external validation. The idea would be to find a way to support, even in the scenario where nobody else may be coming in. You might not be able to give in the same boatloads of money what a larger investor can give, but yeah, you will give enough money for them to continue expansion. So that's broadly the overall thought process around product market fit, structuring of early investments, the supply chain, if I may call it, in the investment universe. Sorry, just a second. Just a bit. Yeah. So coming to startup valuations. So we've covered broadly so far. We've covered how funds are structured and set up. We have also covered how incentives are stacked up, what are the expectations of investors, how we go about performing our functions, what do we do, sometimes things at multiple times. So now it's a logical point to talk about the startup valuations. So far as the startup valuations go, and just to try and cover it up over the next maybe 20-30 minutes, and then the last section around the value adds with the VC and the next steps and all that. So broadly, the way some of these things do operate is there are a lot of rules of thumb that operate. There will be scenarios where it might not be a perfect science, and we reach this point where I must tell you that there are a few rules of thumb. Rule number one is that valuation is sometimes a function of the stage at which we are coming in, and sometimes it's a function of the person we're investing in. So, for example, there could be a scenario where a very seasoned professional or a seasoned entrepreneur who has already had a successful journey is now coming up and investing capital. They have basically come back and said, we are now starting up again. Like I mentioned earlier, they will not be happy to do 50 lakhs or a crore rupees of investment from us and say we will start out. They'll want maybe 20 crores at one shot. Here, it might be a paper plan. The company may not have been incorporated, but the investor who's putting in 20 crores may say, okay, I'm happy to invest 20 crores and take maybe 15% stake. That's it. So effectively, what we have done here is we have valued the company at maybe about 125, 130 crores, and for which we've invested 20 crores. Now, somebody applying the pure play rules of financial management, the principles of valuation, cash flows, DCFs, might say, well, there's nothing. And how have you valued the company at 130 crores? It sounds absurd. In early stage, in digital businesses, like I said, it's not about revenues. It's about the founder. It's about the market size. And it's about whether this is a fundable sector or space or no. Crypto is a big market. There's a great founder in crypto. But Indian regulations are in a zone where we don't have full clarity on how things will shape up. And until the government comes clear and figures out on what is the way forward, people will be circumspect. So there will not be enough money going into the space. So in spite of a good founder, in spite of a great market, they will be tough for people to find investments. So these are the three factors that drive the overall valuations, deal sizes, investment opportunities also. And then there will be a first time fund. who is not very well known in the ecosystem. He does not have people who are going to jump at joy and invest with him right away. Then he might go out and raise maybe 10 crores or 15 crores, and people will say, no, no, why should we invest in you? We don't even know what is going to be your track record, how are you going to perform, what are you going to deliver on, we don't know, so please let it be. We are not investing. He might have to actually reduce his price, and here it's opportune for me to just spend a few minutes and actually clarify that at an early stage it's less about valuation, more about dilution. Evolved professionals here, or anybody who has even passed final CA or inter for that matter, or will come back and say, why? It's the same thing. If you're saying I'm diluting 20% for 20 crores, you're valuing the company at 100 crores. It is one and the same. Well, mathematically, financially, yes, it is the same. But the principle is that you're not saying that you are worth 100 crores. If the founder took that valuation, gave 20% equity to the investor, and now goes and sells his startup, it is not that somebody will come and give him the rest 80 crores in his pocket. That doesn't happen. So it is, valuation is not valuation actually. It is about dilution. I as an investor, happy to invest 20 crores, want 20% because I know that my 20 can potentially become 250 crores after maybe 5 years or 10 years. Maybe even it can potentially become 1,000 crores. I'm happy investing. I'm looking at it, and it need not necessarily mean that you are valued that much. Valuation is achieved when product market fit is achieved. The founder is able to transact his shares, or investor is able to transact his or her shares to somebody else without money coming into the company. The secondary transfer. True value of the company is achieved when there is a secondary transfer, and that is validated when there are multiple secondary transfers coming up all over again and again. And that happens when the company is beyond the 5, 6, 7,000 crores of enterprise value. And ultimately that happens only when the company goes ahead and lists that. That's when the true value is established. Till then, valuation is all just from numbers and mathematics that have worked out. So the concept of valuation, the theory will all remain the same. It is sum total of future positive cash flows. But in our math, when we are running our models and our Excel sheets, we are not trying to figure out DCF and say, okay, this value. Otherwise, terminal value will be the value of the startup. And we can stretch the Excel in whatever ways we want. We can take assumptions. But reality is when the rubber meets the road, you know that in spite of spending thousands of crores, large format companies like a Paytm or an Uber are still not profitable companies. So how are you going to really attribute value to it? So it's like I said, it's about dilution. It's the beauty in the eyes of the beholder. So that's why I said at an early stage, it is about the founder quality. It is about the market opportunity. And if the belief is that it is a mega large market opportunity, if the conviction is that this is a market opportunity where a lot of overall market cap and value can be built out, then there will be more money attracting that sector. So effectively, what I'm alluding to is that valuation at times is a function of demand and supply. We have some really good companies in the portfolio which are doing very well, and they still don't have very crazy investors who are coming in and joining the company as an investor. And then there are companies that are doing as well, and they're valued at maybe 1,000, 2,000, 3,000 crores. So there will be hidden gems and there'll be discovered gems. The hidden gems will be affordable. There will be a lot less value attributed from the market. The discovered gems will be trading at a mega premium. That's the trivial logic on the early stage valuation methodology. Still a few rules of thumb. if a company is having multiple co-founders, they will have a slightly higher valuation. And the logic of this valuation being a little higher is that these businesses are already at a point where the founders are diluted because there are more people who are sharing the kitty. And if there are more people who are sharing the kitty, then it is going to be a bit of a challenge as the stage grows, as there is more money coming in, for the founders to stay incentivized because they will lose skin in the game. So broadly, what happens is at an early stage, if let's say we have invested of the 100 crore fund that I was talking about, we've invested 5 crore rupees and taken 15% stake. After maybe a year or year and a half, with the money that Globe has invested in, you have seen the company scale up to a height, or they have now gotten their full product market fit ready. It's an enterprise SaaS business, SaaS meaning software as a service. They now have a couple of paying customers. They have maybe 30-40 lakhs of monthly revenue. Now, a new investor wants to come in, they want to invest $5 million. That is about 35 crores. They will look at us, they will talk to us and say, you are 15% of the company. Are you going to invest more money into the company? And if the answer is a no, if it's an angel, that's fine. Nobody expects the angel investors to go very deep in the support. But yeah, if they can, great for them, great for the company. But an institution can't really say no. The expectation is that you indicate your strength and comfort in the company with your wallet. So if you are comfortable, you will invest your pro rata. So if your stake is 15%, in that $5 million round that is happening, we will invest 15% of that five, so which is $750,000, which is roughly about 5.5 crore rupees, and the rest of the money will come from the new investor. So we will retain 15%. The new investor will, let's say, for their 30 crores or 29 crores, will ask for 20% or 25%. So we invested 5 earlier, 5 now. For 10, we are holding 15 because we came in early, took the risk and took a higher percentage. And now for just maintaining that stake, we are required to invest a very small amount. Whereas the incoming investor, one shot, has invested 29 crores. Already almost 3x the money to hold similar stake or maybe little larger stake than what we hold. So that's the way and benefit of the early stage. Because we take very high risk, we can enjoy a larger gain when it happens. And now, because we hold 15%, the founder holds and the investor holds 20, the founder will hold only 65. And now 10% of the company will be carved out for ESOPs, right? So here the founder stake is actually only 55. And now imagine if there are 4 founders. So each of them, assuming they are equal, may end up with maybe 9%, 10%, 12%. If they're not equal, it will be 4, 5, 6% to somebody. Somebody may own 20. So there is a skew on the cap table within the founder set itself. And maybe after 2 more rounds, that 5% guy or 10% guy will have become further 2/3 of what it is. So at a mega large stage, they might be reduced down to 1%. There's going to be loss of incentive. Though that 1% of a 7,000 crore company at a unicorn status might mean it's still a big outcome for somebody. But yeah, it is not, because somebody who has been there from the scratch, set up the company at a unicorn level, he might have held 1% or 2%. It might mean $20 million, but somebody else will basically be very happy to have this person, or he might be now having another startup idea and say, I'll start again. And he might start with a $5 million check from another larger investor straight away. So he can keep his equity because everything would have vested and now jump out. So there has to be an incentive. That is why founders have to be given a meaningful stake. And that's why if you have a large number of founders, you value the company a little more, because in some sense you're giving them a credit that more diversity in the team, more functions will be taken care of by senior leadership who know each other, who have worked with each other, or who are friends with each other. or related to each other. Sometimes we see husband-wife teams. Sometimes we see siblings in the same team. We have seen school friends, dorm friends in the same team, and we have seen business associates coming and joining. We have seen boss and subordinate now coming together and joining the startup and running the same team. So there are veracity of factors which are at play here and which operate. And we do see that there is going to be a diversity in the way valuation is going to be worked out. For a single founder team, a valuation of 25% at one shot may not be too much, because after that also he will have 65. 65 because 25 to the investor, 10 for ESOPs, and 65 to the founder. But the same may not hold true for a multi-founder team. For raising $1 million, somebody may offer 20 or 25%. But for raising $3 million, nobody will offer 35 or 40%. Then it's safer and better that you advise the founder that he can hold with $1 million, raise money later when he has more success to show. So there is a thought process around it. There are these rules of thumb that apply into. And an overarching factor that goes around in the valuation attribution is apart. So, like I said, demand and supply. Now, just building the logic bottoms up. So, let's say there's a demand and supply. Demand and supply will be a function of how hot the perception is of a certain vertical. What is it that people feel is going to be raised from the market over the next few years in a vertical like this? So maybe a cab aggregation business before many years was perceived to be a mega large business, and there was a belief that this is going to raise a lot of capital, and it is going to be a big market in the times to come. And precisely because of that reason, we have seen a lot of interest. And when there's a lot of interest, it is going to speak the demand of the stock. But it is coming on the back of very deep conviction that this is a big market. 5 years ago, some markets were not very highly valued, whereas now, many more years later, they will be much better valued. We have seen that when the companies even when Infosys went public, the IPO sizes were 2-digit numbers or 3-digit numbers. They were good enough sizes for companies to raise IPOs. And now, much larger sizes are coming up. You're seeing companies that are starting at 30,000 crore enterprise valuations. The size at which they're diluting in the market between IPO and offer for sale are a chunky amount. They have to ensure that the free float is maintained. So the things inflate. As market sizes grow up, there will be a much larger scope and the valuations will go up. And it is perception driven to an extent on the valuations at an early stage. So there are going to be different factors that end up impacting the valuation at the stage at which we typically operate. And we also see that the valuation does not remain permanent. The valuation is clearly going to be fluid. So as a result of that, a company like in a public market goes up and down. In a private market also, it can go up and down. The big difference though is that in the public market is a well accepted stage that the company is going up and down. It's a function of liquidity, liquidity, market situation on the stock markets, the temporary performance of the company, are a variety of factors where temporary blips may happen. A bad quarter, performance may go down. And the subsequently good quarter, the performance will come up. The communication of the company is a function of the pricing as well. The best of the companies indulge a lot in market communication and having a very strong breadth and diversity in communication vis-a-vis the players that operate in the market. So there is definitely a lot of factors that apply. Whereas in a private setup, it is quite possible that a company will not be communicating at all, because a lot of those things are confidential. A lot of those things are clearly a function of limited conversations between the investors and the company only. And as a result of that, there will not be much of market intelligence around that company, and it is going to be hearsay. Now, in a scenario like that, it is quite possible that the company's performance may not have grown 5 to 10% or 15% on a month-on-month basis. And an incoming investor who's coming in says, yes, I like the founder, I like the company, I believe that the market size is very big, but I think your last round investors overvalued you. They have valued it at $100 million. They have invested maybe $15 million, but you guys are today barely in a zone where you have grown to demand a higher value. In fact, you don't deserve more than what you paid last time, or actually, you deserve a discount. So that way, there is a down round that happens. In a public market, you could simply dismiss the scenario that आज स्टेट बैंक का प्राइस मे बी 600 रुपया है, कल 550 हो गया, एंड परसों वापस ऊपर आ जाएगा. Whereas in a private market, when something like this happens, the company largely ends up suffering odd fate. Not many people may end up coming and becoming investors unless they have a very strong belief and very strong conviction in the business. So that becomes a bit challenging for the poor founder to come back if he had to really raise money at a lower valuation than the previous round. So in some sense, I'm trying to say that when it comes to startups, early stage investing, it is by and large a one-way street. People do expect that you will continue moving up, 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 and it is very, very hard to come back. Once in a year, we have ET awards, and they do have comeback kids, but those literally are cases which are far and few in the economy, and it is a little challenging. So, and one may ask a question that why does it happen? Having raised 100 crore rupees, 15 million is that number. Having investors in the company, why does the company go and raise money at a lower valuation? There are 2-3 factors here. Investor ecosystem has its own challenges. So we, in the investor community, investors do get carried away with FOMO. When I say FOMO, I mean fear of missing out. So when something becomes very hot, we will pay a lot of premium to get into the company. When something suddenly loses flavor with the market, we'll end up valuing it at a deep discount. When we're in the company and we know a lot more about the company, but the numbers are not moving up, we typically may not develop the gumption to support the company and say, yes, you raise the money and we'll support you. You will wait for validation. And this is where we have seen that supporting the founder always helps. We have done that in many cases over. And we have seen the benefits of that. But it's a very tough decision. Because you're not seeing enough people come in and validate, because you're not seeing that in a convention, you have best of companies raise money every 12 months, sometimes every 9 months. An average company, which is good, will raise money every 2 years. But you not raise money for 4-5 years, then you really defend harder. I'm not at all trying to say that these are not good companies. We have had a case like in a company called Exotel, which is a cloud telephony business, where they do offer mobile service communication and infrastructure layer for cloud telephony. And for the first year when they raised money, they raised a measly sum of 2 crores. And that time there were a few lakhs of business every month, single digit. And when they were at 100 crores, no investor had come into the company. Only last year, some other funds started to coming in. And now it has passed the valuation, which is a much higher valuation, and has raised a significant chunk of money. And now it is at a premium. Even now we feel it is a discount and it can do much better, and things will shape up. It is moving in parts and it will do well over a period of time. It is a profitable business. We had no choice but to become profitable. But the second factor that leads to a down round that I was explaining is one, investor FOMOs and investor cold feet post coming in. Second factor is founders burn money very aggressively. Sometimes founder raised 100 crore and he has gone through that money in the matter of 12 months or 15 months or 18 months. This is because you want to scale up very rapidly, you're building plan very rapidly, and you are not in full control. So what is it that leads to these outcomes? Investors and founders. Successful companies are built by investor plus founder combined. Not so successful companies are the responsibility of the investor plus founder combined. So that's broadly what leads to growth success stories. There are cases which we have seen where there are stupendous failures as well, where companies end up reaching a mega large scale and then end up collapsing. It is a very thin and a frothy market. A few people will end up or will try to or aspire to drive the fate of few tens of startups that they can control influence. And so there is going to be a fair bit of competition and competitive forces at play. And it is an incredibly lonely journey for the founder. I'll come to a little more about it in the next maybe a few more minutes. So that's broadly around the valuations. And typically, at a very early stage, for founders who are not very seasoned, the valuation will be sub maybe 30 crores. If there are very established founders, the valuation will go to as high as 300 crores also. And for everybody in between, the answer is in that range, which is between 30 and 300. And at a growth stage, which is not like a late stage but early growth, valuations can be between 200 crores to all the way to 1,000 crores. And beyond that, it's late stage. Sometimes late stage starts at even 3,000 crores. Then there are hedge funds, etc., that start coming in. And when they come in, there's also this challenge where big funds cannot deploy less than $100 million. But they like a certain space, they do believe that this is a good company and a great founder. And they're investing in a company at which has earlier raised money at maybe 300 or $400 million. So they might say that, okay, if you want $100 million, we'll give it, otherwise we can't give. And that's what sometimes results in overinflation on round structures, overinflation on valuations, and a lot more pressure for the company to flow into that valuation. It's not hard. 5-10,000 crore is a mega large number. 98% of India's SMB ecosystem would not need to raise money for their life when they have raised 3, 4, 5 crores. That's how high the number is. But you're trying to be doing radical innovation and move at a very, very frantic pace of innovation to the extent that you're trying to cause disruption. And that is what demands a very, very high risk strategy where you're burning a lot of money. Where does this money go into? Most of this money gets consumed into marketing, creating a product market fit, technology, building a strong moat, and both of these factors are in resources and agencies. So broadly, that's how typically these companies do end up operating at scale. And you also do see that some of these companies at a scale may take few years after a pause, they may miss the cycle and then come back in a very spectacular fashion. So there are ups and downs that keep happening, and we are a much deeper ecosystem than we were, and we do see that there is going to be a significant offtake of the venture ecosystem that it is going to move into a much larger movement. So this is a quick summary of the valuation part. And coming to broadly the last section that I had meant to cover is what is it that we think when we are evaluating investments. I'll just spend a few minutes and then maybe some miscellaneous parts, which I will try and cover. And if at all we are done early, then of course I would love to cover a little bit more around some aspects of venture funding and startups. But yeah, that's more of a backup if we have time. So how do we evaluate investments? There's a lot of content on this slide. We'll let people digest and then start top to bottom. And I'll come to it in a minute once people have had a chance to internalize the slide. Yeah. So broadly, what I was meaning to highlight in these constraints is what are the challenges as investors that we face, what are the challenges that founders end up spending, and how do people overcome, and what are the things that we end up getting help and support from our investors, what we do for our founders, and a veracity of those. So broadly, there is going to be a mega large opportunity that we are chasing. There is a tendency in certain constituents of the market to be FOMO based investors, where people end up investing when there is a lot of momentum and they don't want to really feel missed out. And then there is going to be this approach where we might just be very, very fundamental. So sometimes investors are in two parts where you have a very strong thesis playing out, and then you have a strong founder area that you're going after, and then you are going after a certain change in scenario. So like last time when we had gone through a massive challenge under COVID, we did see that a large number of investors thronged into education, and as a result of it, investments like Unacademy and Byju's did very well. There were also a lot of interest around medical. There was a fair bit of interest around e-commerce, hyperlocal, because people felt that there will be much lesser travel over the period of time. As a result of that, businesses like Dunzo, Swiggy, Zomato, all of them had very strong traction. There was a fair bit of momentum around insurance, which is where there were businesses around sectors like businesses like Turtle Mint, Policy Bazaar, which are into insurance. So a lot of these were a function of people realizing that COVID is not probably going away very soon, and we are actually better off if we build some interesting companies which can scale while COVID is there, and which will eventually scale into much larger habit forming business proposition. So we did see a very significant surge of businesses moving to online because people really didn't have a choice to get into. And thereafter, it's all about scaling. So broadly, from a thought process point of view, the constraint that we try and build artificially on ourselves is decide clearly whether you're a thesis based investor or you are a scenario based investor, or you want to go in only after high quality founder relationships. So different firms, like for example, what we have done is we have a wide leadership team. Different people will concentrate on different buckets and verticals. It is important to impose constraints. I look after fintech investments, for example. I would go nuts if I was focusing on every vertical and everybody's looking after everything. It's hard to keep a track. It's hard to work with the company. It's hard to make a call on what you're going to read, how you're going to meet people, how you're going to create an ecosystem in the country and outside, what are going to be areas of strength. It's really not a marks game, and one has to have a very structured approach. And so either circumstantial constraints or we come up with our own constraints so that we can build a very strong focus around some of these things. Most of the investors of high quality will definitely never get into things which are not in their target segment. Even the people who are looking at momentum-based investing once in a while, momentum-based investing is never a strategy, it's a tactic where people do it once in a while. Even they will never go down the path of doing significant high chunks of investments in market sizes or markets that they don't fully appreciate. There will be a tendency to try and analyze and understand what is the right to win. And one of the right to win is that this is a business which is highly differentiated, and there will be a very large opportunity that will come up. So people will avoid undifferentiated opportunities where they are coming into things where it is not played out. So broadly, we do see that There is going to be some of these are more artificial constraints. And then there are some market-led constraints. So people will generally avoid putting deep money in their own portfolio company, regardless of how well it is doing. They may support it. They may show. We do that. We are one of those few in the market who do that. We have had some co-investors who support the companies together as well, but only so much. By and large, the focus will be that let's get in somebody else so that we are getting validation from time to time. And as a fund, we are diversifying and not going too big into a single company. It's all about the fund mandate and the way the ecosystem matters and the way the ecosystem develops. Because if everything is going into maybe just 3, 4, 5 companies, then we are not diversifying enough and it can really make or break the fund. So broadly, these are some of the constraints that we end up placing on ourselves. The evaluation of the founders is basically who's going to have the gumption to build out an IPO-able business over the next decade. Historically, it has been tough to build businesses that can IPO in just a decade. And we have seen some rare cases where businesses in the past generations have been created in a span of 20 years. But yeah, it takes a lot of time to build. The first batch of companies in India also, which have gone through the IPO path, have been created a decade ago, sometimes even prior to a decade. So you need founders who are going to have that kind of a staying power. Promoter families do have staying power. They run business for 30, 40, 50 years, but here it is different. The stakes are very different. They go down the path of raising incredible amounts of money. There's a pressure to conquer the market. For years together, we were having this challenge that India is a very small market. So if one company gets funded from a large investor, broadly, it is over. That vertical will now be dominated by that company only. It is only now that people are waking up to this reality, and we have been saying it for a while, that India for most verticals is not a winner take all market. It might become a winner take all market where there is maybe a very significant SaaS innovation, or where there's maybe e-commerce play where the platform has to play out. But even there will be 2 or 3 joint winners who are going to be in the market. So it will be duopoly or will be monopolistic at best. But neither it will have like 20 players in every vertical. We do have 20 car manufacturers in the country who sell their cars in India. But yeah, some of these are aberrations, and not all of them are doing brilliantly well. Some of them are stuck because they have invested in capacity, or they have a global balance sheet to stay continued focus in the market. So the idea is to go after founders who are very, very passionate, very strong on their fundamentals, and believe very strongly in the business that they're building into. There is a certain amount of fluency in them where they are coming in and adding a certain skill which will allow them to go and raise money from other investors from the market over a period of time, and they can fight out heavy competition. They can do all that it takes to stay within the boundaries of the law but yet win the market. So these are some of the constraints, and we've seen that best of the founders will be able to work crazy hard, motivate teams to work hard. They'll be able to attract very high quality talent. They will have a very strong willingness to adapt, and they would not be people who will typically easily give up or say a no. So these are some of the traits that we look forward to in our founders. They, while they are hungry and they want to make mega outcomes, they also know that there is an implicit trust that they end up placing in each other between co-founders. There's a slightly larger and a deeper sense of purpose that all of these founders operate with. We have seen enough of those case studies where a founder will come from a very deep rooted personal challenge and then set up a company. So we had a story in our portfolio where a founder was worried about his sister So this was post the women being harassed and challenged in Delhi, the Nirbhaya case. And the founder basically made a app to help her being tracked continuously because she would go out and return to home from a post her office, a post sunset. And then he has now built a very successful logistics business. There have been cases which are slightly more oriented towards building scale or institution, where founders have said, I exited my last business at a very young level, and now I want to really make a mega big outcome, and I don't want to settle for a lesser outcome for myself. So there can be a sense of missionary zeal that comes around with these founders. They will be people who will not go and surround themselves with a lot of obligations around mega EMIs, kids who are going to have very, very deep financial needs. Education, yes. Basics, yes. But not very deep needs around at the time at which they are starting off. So there will be cases where sometimes founders also have spouse who is working, which adds to their conviction and say, let the spouse be settled. I now want to go and capture a bigger journey. So we have seen some of these journeys all through. They are ultimate risk takers. They do give up cushy jobs in corporates and other startups. Some of them have given up jobs which potentially could be earning them about a crore plus, 2-3 crores also, and now come in and take a startup plunge, and they end up starting from scratch and zero. It is a very satisfying journey, all in all, to see some of these scale up. There have been stories on how we have had exits from our portfolio and then founders have come back. They've either become investors in our fund, or they have started again and we have worked with them again, or they have become angel investors in their own might and now sharing interesting opportunities with us to invest into. So it all eventually starts becoming a nice little ecosystem where people are trusting each other, where people are helping each other, and at the end of the day, everybody is responsible for themselves and their outcomes. So it's not that anybody is driving or forcing the other. But yeah, the idea about ecosystem is what we have always been passionate about at Bloom. That I'll reserve for a separate day on what is it that we have believed in and how we have built our institution. But yeah, I'll just thought I'll mention this point. Coming to the uncertainties that the founders face, they end up facing a phenomenal amount of uncertainty, challenges, and ambiguity. So there is this approach that I don't know what will happen. There's a lot of insecurity around it, and which is where, at the smallest of things, situations do end up becoming fairly volatile. There will be scenarios where founders are battling depression, they are stressed, and a variety of factors. And as investors, we try and come in and support them through these phases, connect them to people and experts who can help them through, help our founders with coaching, make sure that they are taking care of their personal and physical health and mental health as well. And as the fund operations scale, as the ecosystem has scaled, I think people are now much more open to taking help from. Sometimes it's minor. People don't even know that they are facing a challenge. Things turn around after 1 or 2 years and things are back on track. So yeah, it is no different from a high friction, high octane, high energy led environment where people are in a small room and are fighting for space. And some will choose to walk out, some will choose to fight out. A few might go the abrasive way of trying to throw others out, but those instances, the digital ecosystem are far and few. They are there for sure. We have seen that on how people try and behave when they reach a certain scale, but those are far and few in between. In general, there is a tendency of optimism. There's a tendency to look at each other with respect. There's a tendency to understand that a 10-year-old younger person can bring something so much more valuable that they can build a mega unicorn and support. So in some sense, yeah, it is like how when somebody qualifies as an article from the firm, there's a tendency to support that person and help in the fraternities. It's digital fraternity and startup ecosystem is somewhat similar, where people do try and help and work with each other and become part of these small informal networks where they're trying and supporting for, well, sometimes for cause, sometimes most times without cause. So, like I was saying, all through we have seen the different types of founder groups, different founder combinations. Uh, there will be a lot of hunger and ambition in these founders. We have seen that sometimes founders will say, I have $1 million, I'll build over the next 3 years. They might not grow fast enough. And somebody from the group could turn back and say, why do you care? So far as he can deliver you a 5x in 10 years, what's your problem? And the answer is in that earlier power law that I mentioned. If you're going to build it slowly and gradually, it might be better off to take money of friends and family and angel investors and build not from a fund. Because a fund has a finite life. Fund has a finite set of resources and they have to make mega outputs for their investors, who could be some of you or some of your clients. So there could be opportunities where people play as family offices on businesses of a lifestyle nature that may not create a scale up 100x in 10 years or infinite levels. It might scale much less, and that's fine too. So in fact, some of them are LPs with us in their personal capacity, where they've invested and said, yeah, we know what it takes to create a business at even 100 crore level. And let's see now, by investing in your fund, if we can be part of journeys which are going to go 100x after 100 crores, which is about 10,000 crores. So there are different combinations. A high-flying corporate who has been surrounded with an assistant, been supported with multiple drivers of office support, high-flying guy may not really be able to create a great startup because he either may not have the same resources to keep him happy and content, or he might basically come with an attitude that, okay, I know it all. And then there are some who have started off as well, but yeah, those cases are far and few. There is a tendency for people to go with IITs, IIMs as founders, Ivy League founders, but now we are seeing a happy trend of CA founders as well. Far and few, very rare, but yeah, we are seeing those combinations as well come in. I've spent enough time around the issues around the market size and relevant areas around valuation, etc. Just a quick summary before we end. I know we have reached literally the last few minutes. But yeah, most of this is covered. I've just put these slides to articulate it better and have a summary for people. So this is typically, you're talking about dynamics at this stage and below. And within that stage also, it is this stage that typically we come in and invest. So all the experiences and stories are at this stage. Like I said, from here to here, the ratio of companies might be possibly 50%, sometimes as low as even 33%. And then exits and IPOs and big M&As are all that outcomes are literally down to 10% and not even half or one third. So yeah, it's a scarily lonely business that we're tracking into. A summary table about how dilutions shape up, how early stage sources of capital stack up, where I was mentioning friends, family, and angel investors, funds like ours who come in at pre-series A and seed rounds, and then the usual VCs and institutions who start investing in these kind of businesses. So broadly, from a stage point of view, there might be, like I said, changes that can happen. So it is possible that this kind of a round could straight happen at the seed stage itself, because it is a very accomplished founder who has done it all, seen the journey, and now his same actual earlier investors are coming into the company and driving the business to the next level. So broadly, some of this is fungible, but yeah, the broad patterns will remain what we have tried to put down on the deck. We discussed very briefly on how a VC model typically will operate. I've just taken a fund size of 60 million as against 100 crore. 20% will be leakage on account of fees, therefore investable corpus is $48 million. Funds will typically keep a reserve ratio. So reserve ratio means that for every 1 rupee that they will invest early, 2 rupees will come in the next stage when there is more validation. So assuming that they want to do a portfolio of 30, 35 investments, the opening check sizes for such a fund will become about 3 to 4 crores. And when they come in with this 3 to 4 crores, they will typically want to make sure that they have between 10 to possibly 20% stake in these companies. And they will have to budget for when we build exit model. What does an exit model build is we start here. This is a time where we need the IPO and the outcome. 10 years have gone, and the company from zero has now become a unicorn plus plus company. So it is now scaled with time and value both is when it reaches here. And what does it take for the company to get there? What performance? How many rounds of funding? So they may raise at least 4 rounds of funding before they become a unicorn. That means that will dilute the investor who's coming in. So then the reserve ratios become useful and important to play into. So this is just trying to give a replica on how typically a fund model operates. A fairly sophisticated science and combination of science and art both. And yeah, so broadly we've covered most of it, and we are bang at time now. So yeah, happy to take a pause. Dr. Mishra, Hemil, Shailesh, everybody, thanks
Yes,
a lot
sir.
again to the institute and its officials for having me over. Happy to be of any further help. Thanks.
Thank you so much, sir, for your sharing of your valuable knowledge. And definitely, all the members has got benefited from your session. And sir, actually, we have although we have very less time, but we have received some questions. So, uh, can I share? Okay, just a minute. So please check your chat box.
Okay, I'll just open the chat. So, Rakesh ji, the question is how much minimum investment is required in VC? So, I'm presuming that this is into a venture capital firm. That investment is about 1 crore and not anymore. If you mean that you have a startup idea, then I'll come to it in the next question, which is by Pragati Agarwal. But by an investor typically to become an investor in a venture capital firm, the quantum of investment that is required is no greater than about 1 crore. If there's a larger fund, they might insist for a larger minimum. SEBI allows that. So as a fund, I can go and say, while the regulatory minimum is 1 crore or 5 crores, we can still expect that people put in 5 crores. So it's a function of what the fund manager's expectations are, what their commercials are, but the regulatory threshold by the SEBI is 1 crore, right? I hope I have answered your question, Rakesh ji. Pragati, your startup idea, I think you will have to, if I'm not wrong, Institute has its own program as well. I'm not too sure about it. You should check that out. In general, it is going to be useful. The best way to track an investor is by looking up to their portfolio companies. So what we always tell people is, if you know people in our network who have been funded by us, it becomes much easier for us to build conviction and attract attention. Just to give you a perspective on why we are not being lazy here by saying that please come through somebody. No, we're not trying to complicate your lives. But just for perspective, in a given year, we evaluate, or we end up getting 3,000 opportunities to look at. We have 5 investors in the team. So that's roughly 400-500 on the lower side and 700 on the higher side per head of opportunities that we end up getting to look at and evaluate. Now, if we are going to try and evaluate everything, it doesn't permit us time to evaluate, do a good job. So there's automatically a tendency to trust implicitly your ecosystem, who you have funded and who has done well. In a fund which is 100 company plus portfolio, there will be 30, 40, 50 companies which have done very well. Come through them. There'll be networks. So it lands you into a spot where there is a credibility build, and this will be true for everybody. I'm just putting out that as a, not because I don't want to keep it a secret. I want everybody to know the importance of network and penetrating networks and making sure that you're leveraging these. Otherwise, also feel free to just bombard people on their mailboxes and make sure that they respond to you. The most of us, if you're not looking at it, we're not interested, we will make sure that we will at least respond once and say that we will not invest by way of a one liner. So emails or writing to those teams are also acceptable, nothing wrong with it. If you have a very strong plan, very highly differentiated, like I was explaining the various criteria, you may end up getting requests from them to share your time and share a larger vision, and you'll be in the play. So that's perfectly fine. There are plays which come in cold. There are people who come in and reach out and say, you have to evaluate and give me feedback. So it's all mixed bag. Can a private limited company be converted to VC fund? Janisha, yes, you can. You have to apply to the SEBI. However, it's not tax efficient. When you declare the money out, there's a dividend distribution tax. It's suboptimal, so it is a tough one. And trust is a most optimal one, which takes care of governance issues and everything else, and therefore a fairly popular method for fund managers in the country to look at. The comment on the stretch valuations of listed startups, Parag, yes, I would agree that there is a fair bit of froth in the ecosystem, and we do encounter these once every 2, 3, 4 years. Last time we encountered a scenario like that was in 2016-17, when there was a fair bit of drying up of capital, and a couple of verticals vanished. Food tech was one of them. We might see a scenario of that nature where very trivial non-revenue making businesses which are just banking on footfalls and site visits and downloads and all that may just vanish. So time and again we have seen that it is only fundamental value adds and value creation that remains, and there is going to be a very significant time and bandwidth invested by VCs to look at models which are sustainable and scalable. So that's where I hope I've answered your question, Parag. Mr. Srinivas, DCF, if not there, what are the other methods? It's like I mentioned, I explained in sufficient detail around the rules of the thumb and the fact that it's about market sizing. There are some standardized plays where if it's a very early company, you're giving $1 million, like I said, it's about dilution. We will expect that we get 15-20% in the company, because when we do the exit model, when we budget that there'll be 3, 4, 5 rounds in the company after this, we will be diluted and it return the full fund for us. That's a bottoms up logic. Top down, we're trying to figure out how strong the founder is. If the founder is not strong and the market is not good, we'll not invest. I am a firm believer, and I tell this to everybody who I talk to. If you are not finding conviction in the founder and the market, stay out. No need to invest. Don't risk by valuing it at half the price. Half the price does not guarantee success or a better return. Sometimes paying a premium is a better thing and getting it. So there are no set rules of valuation, and DCF certainly doesn't work, like we discussed in a fair bit of elaboration earlier. You get how to get protection from a large startup? Not really. It's a survival of the fittest, to be honest. So if you are developing something so powerful, you might have to be in stealth mode. Disclose it to too many people. Don't disclose it to too many investors other than who you are trusting and are very confident of. But it's a double-edged sword. If you don't tell them much, it's a chance that they won't invest in you, they won't be able to have conviction because they don't know you. So if you know the network, if you know that there is a strong player with a lot of integrity, you talk, build your confidence and then share. Otherwise, you do run the risk of some larger company plagiarizing your idea. But at the end of the day, let me tell you, we are a big enough market. So it's not always that just because you're doing something cool, somebody will adopt it. Yes, if they feel that it's of value, they'll adopt it. But please understand, if they're adopting it, it also validates that there is value. So most verticals are not a winner take it all.
So yeah, it's a little bit of circular reference, if I may put it that way. Uh, with ease of business, is India still a far cry from desirable environment? Do you see good prospect? Both different questions. We have done well in spite of all the challenges that we are facing. The only good news is that the government is making efforts. There is a tendency to listen to the ecosystem and come back with frameworks. Unfortunately, the legacy is so rusted and so, I would say, unfavorable that the ecosystem, the regulators, be it the tax authorities, be it the ministries, are not fully be able to go all in and trust the ecosystem and say, yeah, we'll do these things and we'll make these light touch. There is a tendency to take loopholes, and I think we as businesses have to do a better job in making sure that we tell our advisors that tax optimization is not the only job that we are looking for, or structuring creatively to avoid and circumvent laws is not the only goal that we have. And advisors will have to do a good job of telling themselves, their international clients, that India is a stable environment. I'll give you a simple example. Where do you think a foreign investor gets the understanding that India is a rough environment? India is much less rougher than a foreign investor faces, much more rougher than a typical person may have faced. We are somewhere, the reality is somewhere in the middle. Naive people may feel, yeah, things are very smooth and very great, but a foreigner is looking at the lens from the advice he gets from people here. And these are people in our fraternity on taxes, on other areas of business. And then they are saying, okay, India may exit tough hota hai, let's put covenants. India may, there is a problem of taxes, let's structure it through tax havens. Those are challenges. I think we can do away with them. And very early we took the call that we will set up in India. Only we'll pull overseas just for the sake of giving comfort to investors, but the tax was going to be paid, period. And we saw that it made life very easy. So hopefully, if a generation full of people like all of us who are concerned about ease of business think that way, and over a decade we do end up developing trust and confidence in the ecosystem, people do well, and the department does its proactive bit of on implementing laws with the same spirit at which they are made. I think we'll be a better ecosystem 10 years from now. But all in all, I am positively bullish because of the way the changes are being made, because of the way the friction is attempted to being reduced. It will take some time to reach the bottom of the pyramid in the minds of the law implementers also. But I think it will get there for sure. It's about confidence building on both sides, and both sides doing a little more than what they have done so far to be able to get there. Uh, Young chartered accountants in the VC space. I'm not an MBA, and it's not that I'm a CA plus MBA. I'm only a CA. If this dispels a myth that there is reservation, we have. Yes, there's a skew towards IITs because people understand technology better, and we have people who want to be able to understand application of software and all that, and therefore there will be that favor and that bias. It has nothing to do against CAs or in favor of MBAs. It's more to do with the fact that one needs to understand technology very well. And in this day and age, an era of uh, uh, software, the era of Twitter, LinkedIn, I think a CA has an equal opportunity. All that you need to do is start thinking and living about the ecosystem that you want to be part of. Figure out what are the areas that you are most passionate about. Put out your thoughts, write it out on LinkedIn, tweet about it, share with your inner circle, and go ahead and make sure that people know about you and your existence. You might have to do this in a consistent manner to be able to get attention from people who you want to work with. But I can tell you that building your individual brand, putting your thoughts out there in the open market is something that has worked. It does work. And we will need to shed our inhibitions and go down that path. About 20 years ago, as I finished my articleship, I heard a lot of these things as well. And I do feel that a lot of it was true as well, but it was not because people were trying to force us out of it. It was because of the fact that we had not evolved or gotten to push a few boundaries and get industry oriented knowledge and understanding. And getting that has allowed a lot of chartered accountants to be mainstream CEOs of hardcore non-finance businesses as well. There have been people who have done well, and I'm very convinced about the fact that the road is open. But yes, understanding business dynamics, understanding the space, giving up a little bit of our baggage as a chartered accountant definitely helps. The institute is doing its two bit to make sure that there is orientation, can do much more for the sake of its students and early pass outs. But with time, I think those priorities also will come. We have seen significantly more efforts by the institute on the industry side as well, and I'm only believing that this will increase. But you can't wait for the government to accept that a different curriculum is required for a CA to be right for the industry on the business side. You can't wait for institute to take that step. Yeah, if they take, great, but we will have to do our two bits and create case studies. Simple. And when we do that, we pull people in. Over the last few years, we have seen people playing on its pure merit and being part of the industry, and it will happen. How can, yeah, I think, yeah, we are done. Super. Thanks a lot. Sorry, we did go beyond time
Yes, sir,
because I was
definitely.
trying to make sure that I cover all the questions. But yeah,
Thank you so much, sir, for your wonderful deliberation on today's VCM on early stage investing and VC prospective startup funding. I hope all the members has got benefited from your session, and definitely all the members will use for growing their startup. Thank you so much, sir, for today's session. Thank you.
thank you.